Hi, Mark Anderson here, mortgage banker with Paramount Bank. I'm licensed to lend in all 50 states, and I would love the opportunity to earn your business. For today's mortgage rate update, the first thing I've got to get out of the way is an apology. I haven't done one of these videos for, I think, about a month now. Now, there are a lot of different reasons for that. I really have shot myself in the foot. These videos have been incredibly good for me and my business, and I have gotten a lot of feedback from people even that maybe haven't worked with me that have said that they found these videos useful. So I would like to get back in the habit. It has just been an incredibly low interest rate environment for the past month, and one thing that's different about this time around is that the low rates have been relatively sustained and stable. When the rates first dropped, say back in March, there was incredible volatility. It was often the case that you would talk to me first thing in the morning about your scenario, and by the afternoon I'd have to give you the bad news that the rates had changed. And it was always very tough because I didn't want to be that high-pressure sales guy that kind of forced people to lock in on that first phone call, but it just was the case that things were very volatile. That for the past month has really not been the case. We've been in a really stable, low-rate environment, and the rates have really gotten better overall than what we saw back in March. So it, again, shot myself in the foot by not doing these videos. I really am making it a priority to get back in the habit. So for today, here is what we've got to look at. I'm going to be making an argument today that we have seen such low rates in such a sustained manner, and we've seen improvements recently that, in my opinion, probabilistically, I think that we're due for a correction the other way. Now, rates could go up very slowly, but they could go up steadily. Even if the rates are up higher next week than they are today, you're still going to be looking at the lowest rates pretty much in all time. So here is what we've got today. This is a 5-day view of the bond prices over the last 5 days. And so you see, just this week, we have seen improved bond prices, and we've actually seen improved pricing. Now, there's two things going on here. I have made the argument in previous videos that it is no longer the case that things are quite as simple as when bonds go up, mortgage rates go down. That's how it is in a normal market environment. It used to be the case that you could look for easy indicators like if the stock market was having a bad day, that would cause the bond market to have a good day, and when the bond market's having a good day, interest rates get better. While that is still largely true, what we have seen is that there are a lot of other factors that actually determine what rate shows up for you when you go get your mortgage quote. There has been so much that's happened over the last, over this entire low rate cycle. We've had COVID, which really was the, I would say, the main trigger to the low interest rate environment, the concerns in the market over what that would mean for the economy, concerns which, turned out to be well-founded. You also had an issue where the rates got so low so quickly that lenders were absolutely deluged with refinance applications. And that really hasn't slowed down. I took more applications last month than I think I did in my entire 15-year career. I can't think of a single other month where I took as many applications. And also I had a record closing month for 15 years in the business. And so this ramp up in incoming loan volume has been sustained. Now, the problem, especially early on, is that a lot of the big institutional lenders, they had some serious capacity concerns. These are institutions that, as large as they may be, I think sometimes we view them as these kind of giant monolithic entities that are all powerful. Fact is, at the end of the day, you've got to have human beings engaged at various levels of the process. And this is an industry, in the mortgage industry, it's not the most easily scalable in terms of bringing on new people to do the work. It's specialized skill sets and knowledge that really, there's not a degree program for it. You've got to get that experience working in the industry. And so what the industry has been doing since these low rates started, we're really just picking people off from other companies and moving them around and under constant threat of folks being picked off by other institutions as well. So one of the things that drove interest rates, although they were very low, they were not as low as maybe they should have been based on the simple market fundamentals of the bond price versus interest rate dynamic. you saw a phenomenon of lenders essentially holding back, making higher margins than they were typically geared toward, because they were trying to slow the volume that was coming in. That, I would say, we've had a few months now. I would say that there has been some general ramping up. I know my company has hired many new people, particularly in the underwriting department, to keep up with this massive influx of volume. And so one of the things that we're seeing, I'd say, over this last month is that the industry maybe got a little bit used to things, and the capacity concerns, which in the beginning were very large, those capacity concerns were to some degree mitigated. And so you saw margins go down, and therefore rates to go down even further. So what we've seen over the past 5 days, bond prices shot up all throughout the last 5-day period. And you see today, we're really at, I believe it's fair to say, we're really at the lowest rates that I've ever seen. Now, in terms of scale, how much lower are we talking about? I'm talking about maybe an eighth lower for most scenarios versus the lowest interest rates that we saw back in March. And it's not for all scenarios, it's not for all cases, and for reasons I've mentioned in previous videos, I can't quote specific scenarios in these rate update videos. But here, just today, I'm going to zoom into today. What we've got is we had a big spike here, and then the bond prices started falling off. Now, this phenomenon has happened over and over and over again. When bond prices go up, a lot of the investors that control the actual rates, they actually control how loans are priced. When the bonds go up, they're actually very slow to make rates better. But when bond prices fall, they're very quick to make rates worse. So we have actually seen a couple midday price changes for the worse on a very, very minor level. In my company, we're what's called a correspondent lender. So we have a ton of different investors. And so when I go to look at an interest rate scenario, I'm not just looking at one lender, I'm looking at a ton of them. And so the couple midday price changes that we've had, actually my best price investors have not moved yet. So we're still at the lowest levels that we've seen. The case that I'm going to make based on just this today, and I could be wrong for any number of reasons. Again, I think it's bordering on irresponsible to try to make any firm predictions in this kind of environment. I think that we may be at the end of this low rate cycle, and that it's almost as if we're due for an adjustment higher across the board. I don't think if that happens, I don't think it's going to happen quickly. I don't think it's going to be dramatic. I don't think that we're going to see big swings day to day. But long story short, I think that if you have not yet locked in on a refinance, you got to do it. It's time to engage in that process and get that done. If you're looking at a purchase scenario, my goodness, you're facing some challenges on the purchase side because the buy side demand is so high right now, and the amount of listings are not really meeting that demand. So you're seeing a lot of multiple bid situations. I think you could argue that in some cases people are overpaying for properties just to get in the door and to fight those other buyers competing over those properties. But even if you're overpaying to some degree, whether or not you think that's true, you're benefiting from effectively cheaper pricing overall just because the rates are so low. And I do think that is a strong argument to buy if you are interested in buying. There really couldn't be a better time from an interest rate standpoint. One other thing I wanted to mention, and this is I would say a key differentiator between working with somebody like me and working with maybe one of the bigger box lenders out there. I will be the first to admit, in this time frame of the super low rates, generally speaking, refinances have not moved as quickly as I would like. I would say at the beginning of this, we were seeing closing time frames in the kind of 40 to 45 day timeline for a refinance transaction. We could close purchases in 3 weeks if we needed to. But on the refi side, we're sitting about 45 days. We're now, I'll be the first to admit it, we're over 60 days on a handful of files that I took into the system. And this is largely due just to the overwhelming volume that has gone into my company, as well as every other company out there. This is the differentiator. In cases where, say, I've done a 60-day interest rate lock, and we haven't been able to perform within that 60-day time period, I'm extending those interest rates at no cost to my consumers. And that is something that I feel very strongly about, that it's our responsibility to make good on what was promised. The big box lenders out there, you are not going to get very far on that. Even if you could make a strong argument that it's big box lenders' fault that your transaction is not closed within the time frame of the lock, you're going to get a lot of pushback. And it's actually very unlikely, I've heard from several people actually, that were at the end of a cycle with a big box lender that they were going to be on the hook for massive extension fees. They have policies in place that are pretty black and white. They don't have somebody like me on the front end of the transaction that really is totally in control of the business. The way that I operate in my company, it's almost as if I kind of operate my own little fiefdom under the platform of the bank. So I'm able to control the customer service experience, and I have influence over how that type of thing is handled. The last thing that I will mention on this point is about what do you do in a case where interest rates have dropped from the time that you originally locked in. No matter what lender that you're working with, they're likely to have some sort of renegotiation policy. Now, whatever this renegotiation policy is, which if you contact me, I can walk you through what ours is at Paramount Bank. Whatever the policy is, you have to keep in mind, and I know this is a big ask. It's always difficult to get sympathy for people, for banks. But from the bank's point of view, when we lock an interest rate, we're making a financial commitment. We've got money on the line. If we break an interest rate lock, that is not something that can just be handled willy-nilly. One of the reasons that my bank has really, really good competitive pricing is that we do not willy-nilly break locks. We get what's called a high pull-through percentage with our investors, which means that we make good on the commitments that we've made on the rates that we have locked in. And that's something that's very dangerous to give up if you start letting your fallout percentages get too high with your investors. And I've been at companies where this has happened. You see rates get worse, and that's bad for everybody. So whatever the renegotiation policy is, it's likely going to factor in that there are some costs associated with breaking an interest rate lock. So just keep that in mind. I would welcome you to talk to your lender, whether you're working with me or whether you're working with somebody else. If you do think that rates have come down from the time that you originally locked in, it's at least worth the ask. Now that said, when you do lock an interest rate, it is worth pointing out that essentially what the lender is providing you is insurance against the downside, the potential that rates could go up. That insurance against the downside can't be provided without some insurance against the other direction. Otherwise, the meaning and purpose of a lock just wouldn't carry any weight or meaning whatsoever. So when you do make the decision to lock, you do have to keep in mind that that is a commitment to some degree. Now, is it a legal commitment to close out your transaction with the lender at those terms? Absolutely not. You as a consumer are free to withdraw your application at any time. Now, if you've got a good loan officer, they're going to do everything it takes to retain your business within the confines of what they can do under their renegotiation policy. So this mortgage rate update is long overdue. I do intend to do more of these more regularly here in the future. This one has gone on, I think, for far too long. So if you would like me to take a look at your scenario, whether it's for a purchase or refinance, please do call or text me at the number below anytime. I really look forward to hearing from you. Thank you for watching the video. Please do like it and subscribe to my channel for more updates.